And in 1980, that should be a spiky bottom at 1. And today we're at 16. And I am expecting 1 again, or even less, meaning that that gold will outperform stocks by a factor of 16 times. I talk about silver, and we are up at a gold-silver ratio of about 90 to 1. And I'm expecting it to go to like 10 to 1. In other words, if gold rises 200% or 300%, you can take that times 9 would be the performance of silver.
The past week in the markets has been nothing short of volatile, with gold experiencing a $70 trading range on Monday alone and silver swinging by more than $1. These price movements highlight the increasing uncertainty in global financial markets and reinforce the growing interest in precious metals as safe haven assets. MikeMaloney, a well-known precious metals analyst, has pointed out that the current gold-silver ratio, approximately 90 to 1, could shrink dramatically to 10 to 1. Such a shift would indicate that silver can significantly outperform gold in percentage gains. If gold were to rise by 200 to 300%, silver could appreciate nearly 9 times as much, making it an even stronger asset in a potential monetary reset scenario. Historically, the gold-silver ratio has fluctuated based on economic conditions and the availability of each metal. In ancient Greece, where the first coins were minted over 2,500 years ago, the ratio was typically between 10 to 1 and 13.5 to 1, influenced by the relative proximity of gold and silver mines. However, in the 1930s and 1940s, the ratio climbed to 90 to 1 or higher, peaking at approximately 98 to 1 in 1991, with some sources even suggesting it briefly exceeded 100 to 1. While some analysts argue that the gold-silver ratio has lost relevance in modern markets, others believe it remains a critical measure, even if there is no definitive answer to what the ratio should be. The ongoing shifts in gold and silver markets continue to influence the strategies of central banks and institutional investors. As global economic risks mount, central banks diversify their reserves, seeking greater exposure to gold and silver. At the same time, private investors and speculators are increasing their holdings to hedge against economic slowdowns, inflation, and labor market deterioration. Maloney further emphasizes that since gold's peak in 1980, the global currency supply has expanded by a staggering 55 times, while the number of people able to invest in gold has grown 18 times. Given this exponential monetary expansion, previous gold price targets, such as $9,000 per ounce, may now be significantly underestimated. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
When we made this chart, I asked you we're basically doing what is called something similar to Elliott wave analysis, where you've got up cycles that are in 1, 2, and 3 waves, sometimes 5 waves up. And what we did was we took the lowest price of gold after its 1980 high to today. What was the lowest price? It was $253 in 1989. So the blue line is the 70s bull market, the entire thing from the lowest price to the high of 873 in January of 1980. And then we took the current bull market starting at in 1999 to today, and that first wave up where they both hit a high. I just had you line up the lows and the highs. So we had to take the current bull market and squeeze it, and then squeeze it this way to get those to line up just to see. And the correlation, we're going, oh my God, we could not believe the correlation between these two. It was just astounding. And then the last time we reviewed this, you pointed out that something happened right there. Yeah. What happened where it just started going sideways and it didn't match up anymore? It didn't correlate it was a perfect correlation, and then something diverged. So what was it that you said?
The COVID crash, everything sold off.
Okay. And what happened during COVID? We created massive quantities of currency while this went sideways, which means this sideways move, it's just storing energy. So the explosion that comes later, because it's storing energy now in both magnitude of the move and time, because we're past the time limit when this thing should have peaked, and it was predicting $9,000 an ounce then. So I actually think that there's a possibility that might be a low estimate. I don't know.
It is possible.
Silly. Anybody talking about $9,000 gold is considered a lunatic. But if you went back to the beginning of this century when gold was $250 and said that gold was going to be $2,500, it was going to go up tenfold, you would have been called a lunatic then. So because it had been going down. Everybody was saying, I was saying, you got to look at gold. And everybody goes, gold, it's been going down for 20 years. And I'd say, exactly. When it went sideways during COVID, well, Bernanke created $4.2 trillion of base currency. And then that all went through Bernanke and Powell, basically, since then have created all of that. Not Bernanke. This is just Powell, but it ended up at 4.2 trillion of base currency, and that went into the stock markets. It created the bubbles. Then we mailed the checks to people, and we've had huge inflation. And so gold is just catching up here. The expansion of the currency supply has been absolutely enormous since the beginning. The red line starts in 1999, and so the expansion of the currency supply in fact, let me see. I'm going to just read there's a chapter that I believe is extremely important if anybody wants to know how high, if they want to know the fundamentals under this bull market compared to the bull market of the 70s. Since January of 1980, when gold peaked, there is now 18 times more people around the world that can legally buy and afford precious metals. There's 55 times more currency on the planet. There's 56 times more millionaires and 200 times more billionaires. But basically, those first two things, 18 times more people that can participate and 55 times more currency. That's all you have to know to realize that perhaps 9,000 is way low.
The global gold market is witnessing unprecedented demand, raising concerns about the ability of significant exchanges to meet physical delivery requests. As noted by MikeMaloney, if the supply of physical gold becomes too constrained, the COMEX exchange may be forced into a cash settlement-only scenario. Such a shift could trigger a sharp rise in gold prices, as it would expose the market's vulnerability in fulfilling delivery obligations. JPMorgan Chase & Company, the largest bullion dealer globally, has announced plans to deliver gold bullion worth over $4 billion against futures contracts in New York this February. Rising prices and the potential for import tariffs are driving an international rush to ship gold to the United States. On Thursday, JPMorgan and other institutions filed delivery notices for 3 million troy ounces of gold, marking the second largest delivery volume recorded on the COMEX since 1994. The pressure continued into Friday, with traders declaring an additional 1.1 million troy ounces for delivery the following week. These record-high delivery volumes underscore the increasing strain on the paper gold market. While authorities have historically managed to maintain the system's stability, the surging demand for physical metal is testing its limits. If the trend persists, the risk of cash settlements could become a reality, potentially fueling even more significant price volatility and reinforcing the importance of physical ownership in the gold market. Let's get back to the interview.
We want to point out to everybody that we're not tracking the gray bars here. It's those green and red bars that are at the bottom of the graph. And so, there is something going on right now, and we don't know exactly what, but people are getting prepared, that's for sure.
Absolutely. It's gold.
And it's the big boys. This is what bugs me. I said in that video that I hate it when I'm selling people precious metals near a top, but the public tends to chase price. I really love it when I can get somebody in at a low price. Like, during the COVID crash, the gold silver ratio went up to 120 to 1. And I was able to buy when it was at like 110 to 1, which put me in at around $12 or $13. And look at where it is now, 33. So the gains in such a short period of time have been phenomenal. And I discussed it in my insiders report. And I just hope the public is waking up, because it looks like there's going to be a huge move coming up. And I used to joke, I'd say, you look like a $5,000 an ounce guy. And they'd say, what? You're going to wait until gold is $5,000 an ounce before you buy. And there are people like that. They're in the stock market. They're just stuck with it. And they're going to lose 50%, and then they're going to buy $5,000 gold in that rotation that you were talking about. Nick Laird at Gold Charts or Us sent these out in an email, and I saw this and I went, oh my God, because the thing that is amazing is that those other two big spikes during the COVID panic right there, those are the highest spikes on record, but that's for entire months. And this recent spike is for the first 5 days of this month. Just 5 days, and we're already higher than the second highest spike in history of gold deliveries. And this is the problem. This is the reason for the emergency. This is the reason people are that the Bank of England is selling those 400 or loaning out those 400-ounce bars at a discount to spot because people are paying $50 to send them to Switzerland and get them refined into. And I would imagine Switzerland is way backed up at all their refineries right now to melt down these 400-ounce bars, refine them into 100-ounce bars and kilo bars, so that the COMEX can continue their deliveries without a force majeure, without running out and saying cash settlement only, which would cause gold to just like I would feel that it would almost instantly double in price. There would be a scramble around the world for gold if that happened. Probably not going to happen. They patched it up last time. They somehow kept the music playing. Well, everybody is dancing around thinking that they can, in the musical chairs, that they've got a seat when there's actually only one seat for every 10, 20, 50, 100 people dancing. And so this exposes all of the vulnerabilities when this stuff happens. But 5 days, that is an amazing spike. For anybody that wants to do the math, it's 50,000 contracts. A contract is 100 ounces of gold times $2,800 an ounce. So you can figure out how many billions we're talking about in just 5 days.
The gold and silver markets are entering a crucial phase with record high delivery requests and mounting pressure on major exchanges. The increasing demand for physical metal exposes vulnerabilities in the paper market, signaling a potential shift in how precious metals are valued and traded. If current trends persist, the implications for global financial stability could be profound. As institutions scramble to secure physical gold, will we witness a significant shift toward metal-backed assets? Or will traditional financial mechanisms find a way to maintain control? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.